Imagine that the greatest threat to your financial future is not a sudden market crash or even inflation eating away at your savings. The real danger lies in the approving nods of your neighbors and the admiring comments under your photos on social media. There is a paradox that most people realize too late. The more you look rich today, the less chance you have of actually becoming rich. We live in an era where social proof of success has become more expensive than success itself. But while millions of people voluntarily fall into the trap of conspicuous consumption, a narrow circle of individuals chooses the path of financial invisibility. They drive used cars, live in modest homes, and dress in ordinary clothes, while their bank accounts and investment portfolios grow at a rate inaccessible to the understanding of the average person. This is not just a saving strategy, it is a deep analytical game based on an understanding of cascading effects and long-term planning. Today on the SEM Invest channel, we will break down 7 fundamental rules that allow you to build a financial empire in the shadows, while those around you look sympathetically at your old sneakers. Have you ever wondered why people earning $100,000 a year often feel more cash-strapped than those receiving $60,000? The answer lies in a structural shift in priorities. Let's meet Nick. He is a talented engineer in Austin, Texas. His income has crossed the $150,000 mark. It would seem this is a direct path to wealth. But Nick makes a mistake that economists call lifestyle inflation. With every salary increase, he buys a more expensive car on lease, moves into an elite residential complex, and updates his wardrobe. From the perspective of his colleagues, Nick is a model of success. But if we look at his financial statements, we see a dangerous fragility. His savings rate is close to zero. Any market volatility or short-term job loss will lead to an immediate financial collapse. His wealth is a facade, behind which lies emptiness. The cascading effect here is obvious. The more Nick spends on maintaining status, the less capital he has left to work in high-yield zones. Rule number 1. Create a stealth cloak for your capital. True wealth is what others do not see. It is those numbers in your brokerage app that are not converted into a leather car interior. When you intentionally choose modesty, you get rid of the most expensive tax in the world, the tax on other people's opinions. Olivia, unlike Nick, works in the same industry, but her strategy is diametrically opposite. She lives in a modest townhouse bought with a low-interest mortgage a few years ago. Her neighbors think she is barely making ends meet because she drives a 10-year-old Honda Civic. But Olivia understands the math. The difference between the payment for a new Tesla and her old car is $800 a month. If you invest this money in an S&P 500 index fund with a 10% annual return, in 30 years, this invisible difference will turn into $1.8 million. While Nick buys other people's admiration, Olivia buys her freedom, and she does it in absolute silence. Transitioning to the next stage requires an understanding of how the modern US banking system works and why your liquidity is your main asset in periods of uncertainty. When the market faces stiff competition or structural shifts, most people find themselves locked in illiquid assets. Their capital is frozen in real estate or expensive things that cannot be quickly sold without losing value. The second rule states, your cash should work but remain invisible. This is the concept of a high-yield savings account, HISA, as your personal fortress. Consider Bill. Bill is a logistics specialist from Chicago. Instead of investing in dubious crypto assets at the peak of their popularity, he methodically fills his HISA, which now offers about 4.5% per annum. To those around him, Bill looks like a boring person who has no money to invest in hype projects. However, the presence of available capital allows him to react instantly to market barriers. When a real estate market correction or a stock market crash occurs, Bill turns out to be the only person with cash ready to buy assets at a significant discount. The math here is inexorable. If you have $50,000 in an HISA, you are not just earning $2,250 a year in interest. You possess an option on future opportunities. While others are forced to take loans at high interest rates or sell their assets at the bottom of the market to cover current expenses, You use market pressure to your advantage. Bill's psychology is the calm of a predator in ambush. He knows that his financial resilience is directly proportional to his ability to ignore social pressure. This creates a cascading effect of confidence. The absence of debt and the presence of liquidity allow him to make riskier and more profitable decisions in his career, as he is not afraid of losing his primary source of income. But what about long-term planning that is hidden from the eyes of tax authorities and curious acquaintances? Here we move to the third rule, using tax arbitrage. In the US, there is a unique tool, the Roth IRA. Imagine Alicia. She works as a teacher and does not earn enough to cause envy. But Alicia is a master of tax optimization. She maximizes contributions to the Roth IRA. For society, Alicia is a poor public sector worker. But the reality is that her investments grow in a tax-free environment. When her portfolio reaches the $1 million mark in 25 years, she will be able to withdraw this money without paying a cent in taxes. Compare this with Julian, who earns 3 times as much but keeps his money in a regular brokerage account and constantly makes trades, creating tax liabilities at every step. The cascading effect of taxes can destroy up to 30–40% of your potential wealth over the long haul. Alicia looks poor now to be incredibly rich in the future, using legal mechanisms that most ignore in the pursuit of quick profit. This clearly shows that it is not only the level of income that is important, but the structure in which this income works. He who understands the rules of the system and plays them correctly almost always ends up ahead of the one who simply earns more but ignores strategy. The fourth rule concerns the most undervalued tool in the arsenal of the hidden millionaire, your FICO credit score. Most people perceive credit as a way to buy what they cannot afford. The hidden wealthy see it as a risk management mechanism and a lever. Tom is a freelance designer. He lives in a small apartment and uses old furniture. However, his credit score is 820 points. How did he achieve this? He understands the FICO structure. 35% payment history, 30% credit utilization. Tom keeps his credit cards open, but uses only 1% of the limit. For banks, he is an ideal borrower. When the time comes for a serious step, such as buying a multifamily home for rent, Tom will get the lowest interest rates. A difference of 1–2% on a mortgage over a 30-year horizon is hundreds of thousands of dollars in savings. Those around him see that Tom does not buy new equipment on 0% interest installments and think he cannot afford it. In fact, Tom protects his credit potential to capture assets that will generate cash flow rather than consume it. He uses credit not as a method of consumption, but as a strategic tool to accelerate capital growth. And this is the key difference. Discipline today opens access to opportunities that remain inaccessible to most tomorrow. It is important to understand the psychology of behavior in crisis situations. Fifth rule: emotional desensitization to market noise. When a price crash occurs, most amateur investors succumb to panic. They see their portfolio decrease by 20% and fix their losses, following the herd instinct. Ethan, who follows the hidden wealth strategy, treats this differently. He perceives a market correction as a seasonal sale in a supermarket. His strategy is dollar cost averaging, DCA. He automatically invests a fixed amount every 2 weeks, regardless of news headlines. Psychologically, Ethan has separated his ego from his account balance. While his friends discuss the economic collapse over an expensive dinner paid for with a credit card, Ethan calmly increases his positions in broad market index funds. He understands that time in the market is much more important than trying to guess the perfect moment to enter. The cascading effect here lies in exponential growth. By buying more units of an asset when prices are low, he accelerates the capital accumulation process that will manifest itself over decades. Sixth rule: investment in intellectual capital that cannot be confiscated or taxed. Diana is a nurse who constantly takes additional courses and receives certifications in niche areas of medicine. From the outside, it seems she spends too much time studying instead of resting. but every new certification increases her hourly rate by 10–15%. Unlike material assets, her knowledge does not depreciate due to inflation. Moreover, a high level of competence creates a safety zone. In the event of a structural shift in the economy, Diana will remain a sought-after specialist. She does not buy expensive bags to emphasize her status. She buys knowledge that allows her to dictate terms in the labor market. This is a form of wealth not visible to the naked eye, but it is the foundation for all other financial strategies. The cascading effect of learning. A higher salary allows for increased contributions to the 401k and Roth IRA, which in turn accelerates compound interest. Over time, her income grows not in leaps, but in a steady upward trajectory backed by real market value. And exactly this type of growth, predictable and manageable, becomes the basis for financial independence, rather than one-off lucky decisions. Seventh and most difficult rule: patience as a strategic advantage. We live in a culture of immediate gratification. Most people cannot wait 10 years to see a result. They want to look successful today. But true wealth takes time. Isabella started investing $500 a month when she was 20 years old. Now she is 40. There is more than $350,000 in her account. Her friends, who all these years spent money on travel on credit and brand name clothing, have a net worth close to zero despite high incomes. Isabella still lives in the same apartment and drives the same car. But in 10 years, when she is 50, her portfolio will likely exceed $1 million. At that moment, the critical mass cascading effect will kick in. At a 7% return, her capital will generate $70,000 a year, more than the average US salary, even if she never invests another cent. She will become financially independent in total silence, while others continue to work to pay the bills for things they no longer like. And exactly at this moment, it becomes obvious that time is the most powerful asset that cannot be bought but can be used correctly. Those who have learned to wait and act consistently eventually get not only money but the freedom to choose how to live their life. Let's conduct a deep mathematical calculation to understand the scale of this path. Imagine two characters, Owen and Chloe. Owen decides to live life to the fullest. He earns $80,000 a year after taxes. He spends $15,000 a year on a car, payments, insurance, gas, $30,000 on housing in a prestigious neighborhood, and another $30,000 on entertainment and status consumption. He saves $5,000 a year. After 30 years, at an 8% return, he will have about $560,000. This is not bad, but inflation over 30 years will significantly reduce the purchasing power of this amount. Now let's look at Chloe. She earns the same $80,000, but she decides to look poor. She spends $5,000 on transport, an old car, $20,000 on housing, lives in a less fashionable neighborhood or with a roommate, and $15,000 on living expenses. She invests $40,000 a year. After 30 years at the same 8% return, her capital will be approximately $4.5 million. The difference is colossal. $4 million is the price Owen paid, so that people he doesn't even know would think well of him for 30 years. Chloe, at 55, can buy any house and any car for cash without asking the bank for permission. But the most interesting part is that by this moment, she will likely no longer need it. Her psychology has changed. She found pleasure in the process of creation rather than the process of consumption. This is the highest form of financial freedom when you have everything but don't need to prove anything. The hidden risks of conspicuous consumption are often underestimated. When you buy things to match a certain social layer, you voluntarily enter a zone of high financial pressure. You have to maintain this level even if your income falls. This creates a downward spiral. Stress leads to bad financial decisions, and bad decisions lead to even more debt. On the other hand, the strategy of appearing poor gives you a psychological comfort zone. You always have room for maneuver. If the economy faces a harsh correction, you do not panic because your fixed expenses are minimal. You are the one who controls the situation, not the one being controlled by creditors. Consider the example of Bill once more. He uses the 2-4 hour delay rule before any major purchase. This is a simple psychological technique that prevents impulsive spending. When he sees a new gadget or clothing, he gives himself time for his emotions to cool down. In 90% of cases, the desire disappears after a day. This micro aspect of behavior saves tens of thousands of dollars over decades. The cascading effect. The saved money enters an index fund where it begins to multiply. Bill understands that every dollar he doesn't spend today is $2 or $3 that will work for him in the future. This is a long game, where the main prize is full disposal of one's own time. Over time, such discipline turns into a habit that works automatically and requires no effort. And exactly these imperceptible daily decisions eventually create the gap between those who just earn and those who accumulate true wealth. The psychology of wealth in the shadows also includes the ability to say no. Social pressure to go to an expensive restaurant or go on a vacation you cannot afford can be immense. But Nick, who chose a different path at the beginning of our journey, has learned to set boundaries. He doesn't make excuses, doesn't say he has no money. He simply says that it is not part of his current financial priorities. This is a sign of high financial literacy and self-confidence. People who are truly rich are not afraid to look poor. Only those who actually have nothing are afraid to look poor. Concluding our analysis, it is worth recalling the concept of the wealth effect in reverse. When people see their assets growing, for example, the value of their house, they start to spend more. This is a trap. The hidden millionaire knows that paper wealth is an illusion until the asset is sold or generates real cash flow. Therefore, even when the stock market is on the rise, Olivia does not trade her Honda Civic for a BMW. She knows that market cycles are inevitable, and a rise is always followed by a correction. Her task is to stay in the game for as long as possible. Compound interest is a miracle that requires decades of silence and discipline. That is why a true strategy is built not around short-term victories, but around survival and resilience in all conditions. He who keeps his cool and continues to follow the system eventually overtakes those who tried to win quickly. So, the 7 rules of wealth in the shadows. Hide your capital, maintain liquidity, use tax shields, protect your credit rating, ignore market noise, invest in your skills, and be infinitely patient. This is not a path for those seeking instant recognition. This is a path for those who understand that true luxury is not when people look at you with envy, but when you wake up in the morning and realize that you don't need to prove anything to anyone because you fully own your life. While the world competes in who can declare their success the loudest, you can calmly build your future in silence. And if this philosophy is close to you, subscribe to the SemInvest channel so as not to miss new ideas and strategies that truly work in the long run. When the time comes, your capital will speak for itself, but by that point, the opinion of others will be the last thing that matters to you. Wealth is what you haven't spent. Remember this every time your hand reaches for your wallet to buy someone's fleeting approval. The real game is played not on the streets or on Instagram. It is played in your Excel spreadsheets and in your ability to keep your cool when everyone else is losing their heads. Be the one who looks a million less than he is worth, and you will never find yourself in a situation where you need to be worth a million more than you have. This is the strategy of SemInvests. This is the path to true, unshakable prosperity.